I thought I had the stock market all figured out. Momentum stocks, tech rockets, I couldn't miss until a crash made me realize I had no idea what I was doing. I wasn't picking winners, I was just floating on a Fed-fueled bubble. Hey Bowtie Nation, Joseph Hogue here, and while that was more than 17 years ago, it's happening today to millions of investors, and I don't want you making the same mistake. That's why I'm kicking off a new series, a complete course on how to pick winning stocks, starting with the one strategy that changed everything for me, top-down investing. This is the framework I used advising venture capital clients, the one I refined as a market analyst, and the one that built my $1 million portfolio. I'll show you how to use this step-by-step system to find stocks with unstoppable upside and reveal 3 top stocks to buy that I found using this exact process. I want to get right into that first stock that I found with this process, the Grayscale Ethereum Mini Trust, ticker ETH. But more importantly, next I'm going to take you step-by-step into this top-down investing. We've been buying the ETF and into this theme since early July when it was just $24, and the big picture, that's top-down forces I'm going to show you how to find in this video, means this one has a lot further to go. We can start with inflation, which is down from that 9% pace a few years ago, but is coming back up, weakening the value of the dollar, and high transaction costs have everyone from JP Morgan to Walmart looking for a digital currency alternative. And this government is extremely favorable to cryptocurrencies through presidential orders along with the passage of the Genius Act, setting up a framework for stablecoins, and sees stablecoins as a way out of its growing government deficit. Within the Genius Act is a mandate that stablecoin issuers put most of their deposits into U.S. Treasury bills, trillions of dollars in buying government debt that will help force interest rates lower. And so that top-down process, all of this is what led me to Ethereum and that 61% return so far. Ethereum is the infrastructure, the digital road that allows those stablecoins to move from one person or business to another. More than 27% of Circle's USDC supply and 15% of Tether is on Ethereum, and all the leading Layer 2 systems settle on the network. And again, everyone is getting involved in stablecoins from JP Morgan, Robinhood to Circle, but it is all built on Ethereum. So instead of trying to pick that one stock and hoping it leads the group, I'm using this big picture, unstoppable forces strategy to buy that one investment that is non-negotiable. Now, along with those big picture forces, the trends in inflation and the stablecoin adoption, companies like Tom Lee's Bitmine Immersion are now buying tens of billions of dollars in Ethereum, trying to create a corner on the market and keep that price high. More important than that investing idea, though, is the strategy of top-down investing, because this flips the script on stock picking. Instead of chasing stock tickers like lottery numbers, you start with the big picture, the jobs market, and whether the Fed is going to take a giant dump all over the market by raising rates. Sorry folks, more than 25 years plus investing and more than a decade as a professional analyst is going to do that to you, make you a little cynical, and if you miss that big picture, even the best stock picking in the world isn't going to save you. Get this right though, the process I'm about to show you, and it turns investing from a casino into a long-term money-making machine. I'm going to start with 3 free resources to give you that big picture trend, and each one of these I'll link in the description below. But let's start with the business cycle, the phases the economy always goes through, from expansion to peak, then recession and recovery. Now, the easiest way to visualize where we are in the business cycle is with the Fidelity Business Cycle Update, and again, I'll post links to all these resources in the description. Here you can see where every country is in its cycle, from early expansion into the boom and then heading into a recession. Now, clicking on any of these countries in the menu shows you where the trend is over the last 2 quarters. Here we see the US showing signs of a slowing business cycle, not yet in a recession, but going in that direction. And here every investor has heard about that all-important jobs report released on the first Friday of each month, but do you know where to find it and how to use it in your investing? If you go here to the St. Louis Fed research site, affectionately known as Fred by all us economics nerds, and search for the non-farm payrolls, you're going to find that jobs report. And here, you'll want to see the month-to-month changes to give you a feel for how the economy is doing. We'll edit this graph and move it to change in persons. Now, giant changes in the economy can make the graph look all wonky like this, so we also want to change the time period to the last few years. And here's where you see that trend. It's not a great trend lately for the monthly jobs created, falling from 2 to 300,000 jobs created each month last year to almost nothing over the last 3 months. Basically a stalled job market. But then we have a saying on Wall Street that you do not fight the Fed, no matter how bad things look, what other economic data says. If the Fed is cutting interest rates, you don't bet against that market. Lower interest rates and easy money policies can supercharge any economy, so you need to know which way the Fed is going, cutting rates to jumpstart the economy or raising rates to choke it off. Now, the Fed raised rates at the fastest pace in 40 years from 2022 and caused stocks to crash into a bear market down 20%. That means one of the most important indicators you're going to use in this top-down investing is the CME FedWatch Rate Tool, a real-time indicator that uses interest rate futures prices to show Fed rate expectations over the next year. For each scheduled Fed meeting, you're going to see the market odds of a cut or a rate hike. But if you go here to probabilities in the menu, you can see the full year and the trend. The highest probability is in blue here with the meeting dates on the left. Here you can see with the current Fed rate at 425 to 450 basis points, the market expects the Fed to cut once in the next meeting in September, but then not again until December and possibly only 3 rate cuts next year. Now understand, these 3 big picture indicators are rarely all going to point in the same direction. In fact, the Fed cuts interest rates to support a struggling jobs market and the economy, so it's usually cutting when the business cycle and that jobs market looks scary. Now I'm going to show you how to fine-tune your outlook later, but usually I put more weight on those interest rates. Despite a tired business cycle and weakening economy, that's a good sign for stocks as the Fed is getting ready to pump that gas and print easy money policies. Now this big picture top-down investing isn't how I got started. I got destroyed in the dot-com crash, but I'd only been investing for a year and Marine Corporal hasn't got shit to invest anyway. But then fast forward to the early 2000s, I was again riding that momentum stocks, making money hand over fist, drawn by that siren song of fast money and a bull market. But the truth is, the entire market was just being juiced. Low interest rates, a booming business cycle, and easy money. The tide was rising and even dingies like me were surfing the waves. I wasn't picking winning stocks. I was like a cat walking across the piano and thinking I composed Mozart. So it wasn't until that 2008 crash that I would learn how critical this top-down investing strategy is, and then only after losing my hard-earned money again and having to start all over from zero. Now I'm going to show you how to take that big picture and start drilling down into stocks next, but let's look at another stock I found with this, Symbotic Inc., ticker SYM. I found Symbotic late last year when it was still an undiscovered $24 stock, following that trend in AI stocks, but then using the steps I'm going to show you next, getting out in front of it instead of just investing with the herd. Folks, we've made great money following the $365 billion in AI spending into chip makers like AMD and servers with SMCI, but to keep making that money, you need to be investing in the next trend. And that thinking took us to Symbotic, revolutionizing the $1.2 trillion warehouse industry with its robotics, partnering with Walmart to develop all its robotics and delivery machines, and creating an $11 billion joint venture with SoftBank to take it globally. Now, finding those best stocks doesn't start with this big picture. That's your start. That's how you narrow down your list from the 10,000 plus stocks trading on the exchanges to just a few dozen, then dig into those ratios and the analysis. This is where I saw Symbotic had a competitive advantage in its robotics, enabling its 20% plus revenue growth and that $22 billion backlog of orders that is going to keep that growth going. It's this growth and the competitive advantages that will help Symbotic jump from industrial robots to other segments like delivery, security, and cobots to continue that growth. Now back into that top-down process, and once you have that idea of where the business cycle is going, whether it's expansion in a bull market or contraction into a recession, you can fine-tune your stocks according to which sectors of the economy are going to do best. For example, we saw that the US is in the later stages heading into a contraction or a recession, but quick rate cuts by the Fed should make it a short bump into another bull market. And so research by State Street can provide a roadmap to this with those big differences found in stocks depending on the stage of the business cycle. In the later stages, as the economy is slowing down, stocks in safer sectors like consumer staples and healthcare tend to protect your money, while materials and real estate stocks suffer. Into a recession, the safety sectors like consumer staples, energy, and healthcare are going to be your best bet, while real estate and tech can fall hard. Then as the economy starts to recover, when you start seeing that jobs report pick up, real estate and materials outperform as those Fed rate cuts make lending easier and investors look into an economy that's going to be building more products. And finally, before the economy is in full-blown expansion, you want to shift more of your portfolio into the financials and the tech stocks that are going to win. Now, another way to do this, you look for those themes, the tech advances, and the trends driving this market. For this, you can start here with the sector research on the Fidelity page I'll link below. You can see the S&P 500, the market return from the last month to the last decade, and here you're looking for those sectors or broad groups that have beaten the market over the near term, like the last month or 3. For example, tech stocks have been booming here, up 3% in the last month and 16% over the last 3 months. But then we want to dig deeper, so we click through to see these industries within each sector. These are the specific types of products within the larger sector, and you can see, even though tech overall is doing really well, there is a huge difference across those industries. The services side of the tech has gotten slammed, with IT departments pulling back in the face of that slowing economy, while hardware has been booming as those companies buy into the AI data center boom. And you can see how important this is comparing the Fidelity Software and Services Fund, up just 1.5% this year, against a double-digit 11% return on the hardware FDCPX fund. Now, on that same page, you're going to see news for the sector that helps you drill down into each of these industries and trends. But Nation, this goes way beyond just following the herd into stocks that are already up. You need to follow into that next trend by studying the industry and where the money goes next. It's not enough to know that $365 billion in AI and data center spending is going to boost those hardware stocks. You need to follow the money like we've done with this AI supply chain, from the chips to the servers, and then through to software developers. This is how we've made so much money this year, staying ahead of the market in those shares of AMD, Symbotic, and SoundHound AI, up from 60 to 114% in less than a year, nearly $400,000 in profits. Now, Nation, if you're still watching, I'm proud of you, because most investors are looking for the easy button. Nobody wants to know how to invest. They just want some Yahoo on YouTube to tell them what stocks to buy now. Nobody wants to learn how to fish. They just want to go to the fish market and then wonder why their stocks stink after 3 days. And of course, it shows in their returns. Data from JP Morgan shows investors earned just 2.9% a year over the 2 decades to 2020, missing the average market return by almost 5% and costing them millions of dollars. Folks, you need to take control of your money, learn how to invest, and do it the right way, because while I love to dig into the analysis on these stocks, you never know where the hell the rest of the YouTube is getting its stock picks. And that is what this series is going to be about. Not about pulling stock ideas out of your ass or just blindly following YouTubers, but about having the tools to do this yourself. First with this top-down approach, then with bottom-up investing, and the financial ratios and the valuations in these next videos. Nation, give me less than an hour of your time for this entire series, and you will be a better investor. And I wish I had this opportunity, because when that 2008 crash hit, I lost everything in a matter of weeks. That's when it hit me like a meat tenderizer to the family jewels. You'll learn, but you're going to walk funny for years. You see, I had no idea how the stock market or the economy actually worked. I was chasing shiny stocks, thinking I'm a genius, when it was really just the Fed throwing cheap money into the system like confetti at a Wall Street frat party. That's when I dove headfirst into the Chartered Financial Analyst, the CFA designation, the gold standard for stock analysis. I wanted to know everything: how the market worked, how stocks fit into the big picture, the boom and the bust cycles. Then eventually I started working as an analyst, professional stock analysis, and venture capital, and that's why I developed this process I'm sharing in this video. This is not just theory. It's built from hard-earned lessons and a few portfolio gut punches along the way. Before we get to that next stock I found with this process, up 290% in the last 5 years, one last big picture resource I want to give you is from FactSet and the weekly FactSet Earnings Insight Report, a giant report surveying all 500 companies in the S&P 500, their financial metrics, earnings, and analyst expectations. I use a lot of these charts and analysis in the videos, but one place I always go is to the earnings growth estimates. With this year passing, I want to see which sectors analysts think are going to be the best profit growth drivers next year. And here we see the overall market. The 500 stocks in the S&P 500 index are expected to post earnings growth of 13% next year, a solid pace of profit growth. But I want to pay closer attention here to those faster sectors. The stocks in energy, tech, and materials expected to see earnings growth from 17 to 19% for the year. I'll then combine that information with valuations, which sectors and the stocks are trading cheaply. The dark blue bar here is the current price of the stocks in the sector over their expected earnings, so a price-to-earnings measure for how expensive the group is. The green bar then is the long-term average for that valuation, how much investors have been willing to pay for those earnings over the past 10 years, and we can see almost every sector is trading much more expensively than in the past. For example, stocks in the technology sector are trading for $30 on every $1 of earnings, a 30 times price-to-earnings ratio, which is way above that 22 times average. In fact, it is 36% more expensive than that average. On the other hand, a few sectors like healthcare and energy stocks are trading more cheaply right now, priced at PE ratios below or a discount to what investors have paid in the past. Now, we're going to go deeper into the ratios like price to earnings and how to use them in our bottom-up investing and our ratios videos coming up. But if you want to cheat a little bit, the report is also going to show you where analysts think the best returns will be over the next year. By comparing analyst price targets for each stock in the sector against where the stock price is right now, the report shows a sector-level return forecast. For example, on those solid earnings growth and the dirt-cheap valuations, analysts see healthcare and energy stocks outperforming with 20 and 18% returns over the next 12 months. Next, I'm going to reveal one of my favorite stocks, one with the unstoppable forces we're talking about in this video, that top-down process that says you can't lose, but there are other ways to pick stocks, and I want to give you every tool available. I'm going to put a clickable card up here in the corner and link to it in the description when more videos are out in our 7-video series, from analysis to the financial ratios and valuation techniques I used on Wall Street. Everything you need to make money investing. And the big picture has taken shares of CrowdStrike Holdings, ticker CRWD, up 56% this year, and almost 300% over the past 5. Now, you out there in the nation know this is my favorite stock and my favorite growth theme because cybersecurity is the one group of stocks that defies economic cycles and the boom and the bust of the business cycle. From hacking to email phishing, more than half of all businesses got hit by ransomware last year, and with the average cost of data breach nearly $5 million, and some into the hundreds of millions, cybersecurity is the one place a company cannot cut from its budget. Overall, IT spending on cybersecurity is forecast to grow at a 12% pace. But if we look even closer, we see CrowdStrike is leading in those segments of cybersecurity that are growing even faster, like cloud with 24% growth, analytics and endpoint with growth of 15% and into-market spending. Now, CrowdStrike doesn't have the fastest revenue growth in cybersecurity or the best profitability, but it is leading in that next-generation tools like AI threat assessments that are going to make this a market winner. Now, congratulations, because at this point in our investing process, you're already 99% done because you know all the companies within those trending industries, the growth theme, are going to boom along with the economy and that big picture forces. This is exactly how I drilled down into the networking stocks I highlighted mid-February. 5 stocks that are already up an average 32% in less than 6 months, and against a market up just 5% because I used this top-down investing. In fact, with this top-down approach, you can do less company analysis, the research into those ratios and valuations and the businesses I'm going to show you in those other videos because you know that the big picture forces and the industry trends are going to be pushing all the stocks in that group higher. Nation, the stock market is not always going to be this forgiving. You can get lucky riding a bull market for so long, but when the big picture shifts, that bull turns into a bear and is hungry for blood. That is why this top-down isn't just a strategy, it's your roadmap, your best shot at not getting wrecked in the next market crash. Now, I learned the hard way, so you don't have to. Check out the video on the right for the next in our series and learn in 20 minutes what it took me a decade to learn on Wall Street. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.